right. Good morning, everybody. So the wait continues. A nice little rug pull yesterday. Gotta love those gap up at the high. It's a really nice pattern when we get them. Still in wait mode. We made it through the first part of QRA as anticipated. There's not expected to be any change to the funding. He's just riding on Yellen's coattails at the moment. There's, no reason to change. So when there's no change to QRA, we tend to just keep doing what we're doing, right? Unless there's some other liquidity event that sends us careening in a different direction. Hong Kong down by a minor amount. Dow up also by a minor amount. S&P at a quarter. NASDAQ closer to a half, and small caps above a half, although just barely. This continues what we've been seeing with small caps leading the way early in the morning, and then they fade out and the broader market takes over. We haven't really seen that flight to safety, right? It's just been a game of musical chairs. They continue to keep the wall of worry front and center for the average investor to stay just bearish enough that we continue to grind higher. And until this dichotomy is changed, then that's our reality, right? So they're going to keep up with the negative press and the negative news and the confusion and doubt and the big headlines to keep everybody freaked out so that the average investor continues to try to short things. And we'll just keep grinding higher through it. Once that changes, CTAs and VC funds and everybody else starts piling in short while investors try to go long, then, we'll flip the game around. Europe's doing well this morning, better than everybody else, up 1%. And we continue to just hold the line, waiting on Powell. I've seen a number of rumors that we're going to cut Wednesday. And some of these rumors are based on a tweet from the administration Friday that when the president said Powell indicated that he was going to cut Wednesday, when the president was talking to Powell at the Fed headquarters, right? They went out to the construction site, they met, been a bunch of pictures, it was in the media. He said he got a hint from him that he was going to cut. What was the hint? Powell said, yeah, the economy looks good. That was the hint. Really? That's it? That's the hint? And that's what popped us Friday and carried it through the weekend. And markets are going to be a little disappointed, right? If they don't get the cut. And everybody else out there is projecting a cut. Only the administration or is projecting that we stay sideways, and only the administration is saying, yeah, I think we're going to cut, because he gave us a wink and a nod and a hint that he was going to cut Wednesday. Seems a bit flimsy to me. So we want to consider temper tantrums if the market doesn't get its way Wednesday after pricing in a cut. So we're going to get a little bit of job data today. It's not the big jobs data, and the numbers are not far apart. There should be nothing really coming out of that, right? But we could get a surprise number, or, the revision that comes with this could be a little off. So just keep 10 a.m. on the radar. Really not expecting anything out of it, but, best to be prepared. Besides, watch the clock, right? You always want to know when we're going to get a new hour. Auctions again today, just the 7-year, but whenever we have an auction, you want to pay attention to that. If you're unfamiliar with the JOLTS data, this is what we call the take this job and shove it data. It's the perception of how easy do employees think it will be to find another job somewhere else. When jobs are scarce, you really try to keep the job you have, right? If you were working back in 07 and 08 during the global financial crisis, jobs got scarce. Rigs were hitting the dirt all around me in the oil field. And if you had a job, you hung on to it with everything you could because you knew if you lost it, there wasn't another one to be found. That's the JOLTS number. It's really easy to remember what JOLTS is once you think of it that way. We're going to get the second half of QRA numbers tomorrow morning at 8:30. And then, of course, we have FOMC at 2 and then POW at 2:30 tomorrow. We had the dollar yesterday run back up to 99. It's a heck of a move in a very short term. And that's one of the things that you really want to focus on when it comes to the dollar and the 10-year is not just where is it at, it's how did it get to where it's at? And you never want to see fast moves in either of these. So we had a swift move down, and now we've had the swift move back up and actually broke the last pivot. So look for, say, 98.5 as a line in the sand. Although you could just measure this whole range and mark the mid. That might be, like closer to 98.25. But either way, if we can keep the mid, we can re-challenge this high and get back up into like $100. And for the 10-year, it's just holding underneath the middle of this pullback. I want to see it get back above the mid and to get back up to the previous high. The problem is, or the concern is, that we just set a lower high and that we're going to next come down and make a new lower low. That's not going to be good, right? That's the current concern. So keep your eye on the dollar today. These swift moves, the rate of change in the dollar picking up speed like this is not good. Just want to keep your eye on it. The put wall was rolled up a lot. So we are really close to where the call wall level was on the put side. Let me see this picture and bring it over here. All right, so I take this picture if there's been changes to the call and the put wall, and I post it in the morning when I post the spot gamma levels. And you can see, this this level here, the puts have been the calls have been stalled out there. Same. They're still stalled out. But look at that move in the put wall yesterday, right? So in that roll up, it's higher than the put wall has been previously because we were topped out here the last 3 times we got up in that zone. So we kept bumping our head there, and now we've rolled that put wall up a lot. Generally speaking, that's considered a bullish bias, right? We're bringing the foundation closer to current price, which makes it easier to push off of. Having said that, though, there's history here where we've seen a put wall rolled up like this, and then we end up dropping down into it, challenging it, and breaking it. And because it was so close to us, we had a lot of momentum pressure that we were able to break it. Because if you think about it being much farther away, say if it's down here and price usually is in the middle of these two lines, and we start to fall that day, we got a long ways to fall till we get to that put wall, which exhausts traders. It uses up a lot of liquidity. By the time we get there, markets are often exhausted. But right now we've got the call wall here and the put wall here, and it's just a tight little range. So if we do start to push to the downside, we don't have to travel very far. Markets wouldn't be exhausted when it got there, and it would be much easier to break that level. And if we break it, well, then we don't have anything down below, right? Other than the idea that we've still got the volatility trigger and zero gamma levels. It's not like there's nothing down there, but still the put wall has been rolled up, and we do see that, generally speaking, as a bullish maneuver. 48,000 in the overnight volume, coming in a little light, but it's not standing out, as a big risk. After that nice move to the downside yesterday, testing the 4-period daily moving average. That's how far we fell down to just test the 4, and then we came right back up again. We're back above the midpoint, and we want to keep it. That's 64.32 cog line. Now you can focus on the RTH of yesterday instead of the entire range. And we've already had our 1, 2, 3, 6 reversal. So now we're back to that 64.32 area. We need to keep it no matter which one of those projections you're using. And if we can keep it, we can get back up to yesterday's high. If we fail the mid, which is basically the RTH high of yesterday, then we're going to challenge 21, and then back down to 64.11, the low of the day, and then we'll worry about Friday's low. Simple enough. Yesterday, the discussion was about getting that gap closed and whether or not we were going to stay inside of Friday's range or if we were going to bounce back out of it again. Well, we finished the day inside of Friday's range, but now we're back out of it again. So that's what we want to focus on. On the daily, we broke out yesterday above that Bollinger Band. Actually, we did it on Friday, right? Bollinger Band breakout, continuation, reversal, back down, tested the 4 again. And now here we are. And this is what we want to focus on. This is an inside day at this point. It's not IX10 or anything like that, just an inside day. And we've got to get out of this box. Now, if we get out of the box, that means we're below the 4 and we're headed to the 10, 63.83. If we get out of box the other direction to the upside, then that means we're continuing this Bollinger Band breakout, which is kind of extreme. You can see we tried it here. Those failed. Then we finally did it, but then we failed, came back in. Getting outside the Bollingers is, it's not unheard of. It's possible, but it's hard to maintain, hard to sustain when you get it. So it's more pressure on the market. Doable, but got to keep it in context. So 63.83 if things get a little ugly, and we're not even expecting that, right? That's the whole point. It is a big week, right? With QRA and FOMC and tariff deadlines on Friday. There's a lot going on. But so far, we don't have any signals that say we should short this market. You know, everything continues to point to continuation. All right, we're getting close to the upper ADR. Well, we were before we started to back away from it, but we're still up 0.25%, which implies we're more likely to hit the upper ADR than we are the lower one. Plus, we would have to break out of yesterday's range to hit the lower one. So while it's possible for us to hit the lower one first, it's not likely that we'll hit the lower one first. This is our range for the day, though. Make no mistake about it. We've been range bound for the most part, holding the line while we wait for the data on Wednesday. And while we might peek outside the box here a little bit, we're not expecting to go anywhere up or down until we get that data. It's a hold the line kind of week. And yesterday's gap up on the news demonstrated that perfectly. We had news over the weekend that caused us to spike up Sunday night, and the markets just washed it right back in again because we're not supposed to do anything until FOMC. That's one of the really great things about preparing for the week and evaluating what we've got on the agenda is to focus dynamically on the idea, what are we supposed to do this week? Instead of approaching every single day as if it's some isolated day that, you know, just appeared out of nowhere where we have no idea what the heck is going on. Of course we do. Doesn't mean we're going to get it right, but can at least try to find what the market is anticipating. We had an MDP yesterday that finally got hit. So by the end of the day, it wasn't an MDP. That's a missed daily pivot. So we hit it. We did get back above it. Today's pivot opened higher than yesterday's. That's bullish. Price opened underneath it. That's bearish. Those two kind of cancel each other out. We've made it through the pivot point now, which means we've hit it. It doesn't owe us anything at this point. Price doesn't need to go down there and hit that pivot, which is good. It removes any negative weight that we might need. And the top of that pivot channel, 64.32 cog line. And on the day, I think we need to keep that pivot. Let's stay above it. We really don't want to get back down below it. We have R1 at 64.50 and S1 at 6,400. That's a tighter range than the ADR, and I like that tighter range a little bit better. I do. I think that would be a more appropriate range on the day than the ADRs today. They're close. They're not far off from each other, but ADR high and low or the SNR 1 levels today, either one of those, because we're not expected to go anywhere, right? That's kind of the default theme. Just keep repeating over and over. We're not supposed to go anywhere. Having said that, you know, be mindful if we do get news or some other headline that does propel us to one side, you know, don't fight it. Just play what you get. But the main thing is we're not supposed to go anywhere. So if we challenge yesterday's low, we should come back in again. And if we challenge yesterday's high, we should come back in again. Play the 1, 2, 3, 6 and the 111 reversal and come back in. All right, we've got a decent distribution started slightly above last week's point of control, and just a little below the 32 cog line. So if we do try to fade to the downside today into that 64.25 area, it's the week's point of control. So that would be putting us back inside the value area, and it's likely going to be our distribution area. It should be where we coalesce. Not really worried about that there. It's this area here. That's your distribution zone at this point. Ten-day, 30-minute volume profile with TPO. The point of control hasn't moved yet, which is what we expected because we have to get to at least these candles here, and that's going to be later this morning. If these candles aren't enough, then we've got another day and a half to 2 days before we get to these candles, before this thing moves. It'll either be because we wipe out these candles, or because we come down and we put enough volume in at that 64.11 area that it becomes the new point of control. Might be hard to see on the screen here, but we've got an elevated volume node that extends all the way out to here. And when we came down into that level yesterday, we built that volume out even more, right? So we've been putting in some work here. All we have to do is come back into that spot, put in a little bit more work, and we could bring that point of control up. Right now, the volume on that point of control extends all the way out to here. But as we take candles away, this is going to shrink, right? And once that shrinks enough, the point of control will move. So it'll be from one of two reasons, or maybe a combination of both. We get more of these candles off the board, and we put more candles on the board at that 64.11 and bring this thing up. If we don't go back down to 64.11, the point of control is still going to go there eventually. We'll just have to wait until we've eliminated enough volume from down here that it becomes the next default location anyways. So it's still going to be the next point of control. Question is, how long is it going to take to get there? The new cog line, or the new VPOC that we marked yesterday, is already done. We hit it, taking it off the board, so we don't need it anymore. If we continue to the downside, 63.92 cog line is the next level in focus. We don't have a VPOC from yesterday because we basically opened on the point of control and spent the initial balance there last night. That's a really tight initial balance. Just a really tight range, opening range, right? 1 hour open range. We have a discrepancy between the TPO and the volume profiles point of control. Red line up here versus the red line down here. Showing there was more trades at that 64.27 area, but there was more volume at that 64.37 area. They'll line up. They'll work it out. Looking at the expected move for the week, we have done nothing. We have gone nowhere. And the best we can say is we're above Friday's close. That's about all we got. We're still looking pretty good with our distance above the 10. I did get the indicator built yesterday to define the rate of change of the 10 moving average. So it's built. I'm using it to evaluate whether it's doing what it's supposed to do. Because sometimes, you make an indicator and you think it's going to do one thing, and then it's doing something completely different. I'm willing to share it. Just be mindful that I haven't tested it yet, right? We haven't had a chance to use it on a day-to-day basis for a while, and could get some unexpected results. So usually I kick the tires for a while before I share new studies that I have built. but this one's not really a complicated indicator. So if you guys want it, just let me know. I don't have it built for TradingView, but there's no code in here that couldn't be used on TradingView, right? Like, Thinkorswim has options code that you can use that doesn't work on TradingView. So that would be something that you couldn't transfer over. But this is not using any options data. It's just looking at price and the 10-day moving average. Each one of these histogram bars or Schwab bars defines how far that 10-period daily moving average moved each day. And then the yellow line is just calculating the average of those bars. That's it. Right? Simple, sweet. And then I added a little label up here to tell us what's the moving average we're looking at, the 10. How many days are we looking back? 20. And what's the average right now in points? Because I use it on the ES, so it says the word points. If you look at Apple or something else, it's still going to say points. Whether that makes sense or not doesn't matter to me. So right now, the 10-day moving average is moving at around 12 points a day. If we want to stay above the 10-day moving average, we need to move at least that, right? Or it's going to catch up to us. We're 0.86% above the 10-day moving average. If we move 12% up and it moves 12 points up, I meant 12 points on both of those, then we're just going to keep our distance, right? There's a lot that we can use this for, just getting started, but how fast it is changing, the slope of those changes, like back here when it was really swift, it was changing fast. Moving averages move quickly when we are far away from them. And when we are close to them, they don't move very much, right? Because we haven't dragged them kicking and screaming in one direction, higher or lower. So right now we're running at a pretty mild pace and it is slowing down. Which, by the way, when this is pointing lower, when it is slowing down, that is because we are trending well. Nice, decent, small candles, consistently sized, just moving, marching to the upside. Keeps this really low, and it just keeps us grinding higher. So on the 10-day, we're not even 1% away. We're not extreme. We haven't moved too far, too fast, and it doesn't owe us any pullback. Looking at the weekly, now we're 3.5%, and we're above that. We need to keep it under 4 so we don't get extreme. And with this too, we're on the decline. We're just fading back nice and easy. It doesn't owe us anything. We're not overbought. We're not overextended. And there's no reason to think we're going to get some sort of pullback or mean reversion because we're just keeping the pace here. We've got nothing down this morning but the VIX. And over a 5-day period, the VIX is now down more than 4.25. So, I mean, there's nothing here that's down. One of the things I noticed that was up this morning is SMH. When I was looking at what was down earlier, chips are up. So we can see the Mag 7 group is up. Same with chips, China, tech, generically speaking, bonds, Bitcoin, China again. A lot of value stuff is not really pushing at this point. We've turned that corner again. Now, maybe it's a 1-day play, right? Maybe it fades out by lunch, but we don't have a lot of that value stuff this morning. Still, for a rally day, the things that we want to see are here. Chips, China, Bitcoin, that's enough to rally. Get one of those breakout days. The thing is, we're not supposed to have a breakout day, right? We're supposed to go sideways into FOMC. So that's where we're at. That's what we want to really focus on. Whether or not we're going to get another fake breakout, if they're going to test the edges between yesterday's high and yesterday's low, they could, if there was any reason to expect that we were going to get something out of FOMC, right? They would front run if they thought there was going to be a change to the outcome. But we're not supposed to get any changes, right? It's supposed to be a non-event where they don't cut and they don't raise and they don't do anything except kick the can down the road. So there's no reason to front run because there's no change to the message. Now we've got QRA tomorrow morning and they could front run that. But when we looked at the QRA numbers that came in, the proposed numbers that came in yesterday afternoon, also no change anticipated. Same old, same old. No reason to front run that either. So we want to anticipate if price breaks either edge, that we play the reversal and we run it back in. If that trade is wrong, we will lose, right? Losing is a part of trading. It's just the way it goes. But we would then be able to just flip around and take the other side and easily make back that loss. It's not like, those are LRE entries, low risk entry plays. So even if they don't work, it's not like you're going to get your eyes gouged out and then you just take the other side, because if we're wrong, it's going to be one heck of a trend and there will be plenty of run to the upside or to the downside on the continuation of the breakout. The thing is, I don't think we're going to get a continuation of the breakout. I think we're going to come back in again if we're even able to break out at all. Because at this point, either edge is a long ways off. We've got an average daily range of 0.74%. We are up a quarter. We could move another 0.5% higher or lower, and that would give us our ADR level up here. 0.5%. To the downside, we'd have to retrace this quarter and then move another 3/4. So we'd have to go 1% in that direction to hit this level. I expect sideways into FOMC. That's the base case, and that's what I'm going to continue to run with until we get something else. So what I got for you guys, be careful, be safe, keep your eye on the clock. We got that auction today, and I'll see y'all tomorrow.